In a market where fortunes can shift within hours, the latest tremors in the cryptocurrency space have once again captured the attention of investors worldwide, as Bitcoin finds itself grappling below the psychologically significant $76,000 level amid a renewed wave of volatility that has sent ripples across the entire digital asset ecosystem. This development comes at a time when global economic signals remain mixed, leaving traders and long-term holders questioning the near-term trajectory while weighing the broader implications for the industry. Welcome to this update from Crypto Hub, your trusted source for in-depth analysis on the evolving world of cryptocurrencies, where we cut through the noise to deliver clear, professional insights grounded in the latest market data and trends. Today, we delve deeply into the ongoing struggles of Bitcoin and the broader crypto market, examining the factors driving this volatility, the technical landscape, potential catalysts on the horizon, and what this means for investors navigating these uncertain waters. The cryptocurrency market has always been known for its dramatic swings, but the current episode underscores a familiar pattern, where external macroeconomic pressures intersect with internal market dynamics to create heightened uncertainty. As of the latest trading sessions, Bitcoin has been trading in a range that has seen it dip below $76,000, with prices fluctuating around the $75,000 to $77,000 zone, reflecting a cautious sentiment among participants. This struggle is not isolated. The total crypto market capitalization has experienced corresponding pressure, with many altcoins mirroring Bitcoin's movements, and in some cases amplifying the downside due to higher beta characteristics. Ethereum, for instance, has faced its own challenges, hovering near $2,000 to $2,100 levels, while assets like Solana, XRP, and various Layer 1 protocols have shown increased sensitivity to the prevailing risk-off environment. Such volatility reminds us that while cryptocurrencies have matured significantly over the past decade, they remain closely tied to broader financial markets, investor sentiment, and liquidity conditions. To understand the current situation fully, it is essential to look at the recent price action in context. Bitcoin had shown signs of stabilization and even modest recovery attempts in the preceding weeks, briefly testing levels above $78,000 before facing renewed selling pressure. This pullback has triggered liquidations across leveraged positions, with reports indicating hundreds of millions in futures contracts being wiped out in short periods. The mechanics behind these moves are straightforward yet powerful. When prices decline sharply, automated systems and margin calls force traders to sell, exacerbating the downward momentum in a classic feedback loop. In the current environment, this has been compounded by reduced trading volumes in some segments, suggesting that while institutional interest remains present through vehicles like spot Bitcoin ETFs, retail enthusiasm has tempered amid the uncertainty. Professional observers note that such phases often test the resolve of market participants, separating those with strong convictions from those reacting to short-term noise. One of the primary drivers behind Bitcoin's inability to sustain momentum above $76,000 appears to stem from macroeconomic headwinds that have influenced risk assets broadly. The U.S. Federal Reserve's recent communications have maintained a measured tone regarding potential interest rate adjustments, with officials emphasizing data-dependent decisions that prioritize inflation control and economic stability. Higher for longer interest rates tend to weigh on speculative assets like cryptocurrencies, as they increase the opportunity cost of holding non-yielding investments and tighten liquidity conditions. Investors have been closely monitoring treasury yields and equity market performance, where correlations with Bitcoin have strengthened in recent cycles. When traditional markets exhibit caution, crypto often follows suit, though sometimes with amplified moves due to its 24/7 trading nature and leverage availability. Additionally, geopolitical developments, including tensions in various regions that have impacted energy prices and global trade expectations, have added another layer of complexity, prompting capital to flow toward perceived safe havens temporarily. Delving deeper into the technical aspects, Bitcoin's chart reveals a consolidation phase characterized by repeated tests of key support and resistance levels. The $76,000 mark has acted as a notable threshold, with multiple rejections highlighting seller interest at that zone. Analysts point to moving averages, such as the 50-day and 200-day, as critical reference points that traders are watching for potential breakouts or breakdowns. On-chain metrics provide further insight. While long-term holder behavior shows relative stability with limited large-scale distribution in some cohorts, there have been instances of increased activity among shorter-term participants reacting to price swings. Realized volatility has remained somewhat contained compared to historical bear markets, yet implied volatility in options markets indicates expectations of continued choppiness ahead. This environment favors strategies that emphasize risk management, such as position sizing and diversification across correlated yet distinct assets. For those employing technical analysis, indicators like the Relative Strength Index, RSI, have dipped into oversold territories at times, occasionally signaling short-term relief rallies, but sustained momentum requires broader confirmation from volume and fundamental catalysts. The role of institutional adoption continues to be a cornerstone of the crypto narrative, even amid volatility. Spot Bitcoin ETFs have seen fluctuating flows, with periods of inflows reflecting confidence from traditional finance players balanced against outflows during risk-off episodes. These vehicles have democratized access to Bitcoin for many, bringing in capital that was previously sidelined due to regulatory or operational hurdles. However, the mechanics of ETF rebalancing and redemption processes can themselves contribute to short-term price pressure when net flows turn negative. Ethereum, benefiting from its own ETF approvals in prior periods, faces similar dynamics, but also grapples with network-specific factors, such as gas fees, staking yields, and developments in Layer 2 scaling solutions. The broader market has witnessed rotations into sectors perceived as more resilient, including certain DeFi protocols, AI-related tokens, and real-world asset tokenization projects. Though these too have not been immune to the overall sentiment, this diversification trend within crypto highlights the maturing ecosystem, where not all assets move in perfect lockstep with Bitcoin's dominance, which itself has hovered at elevated levels during uncertain times. Looking at historical parallels offers valuable perspective for the current volatility. Bitcoin has endured multiple cycles of boom and bust, from its early days as a niche experiment to its current status as a multi-trillion-dollar asset class. Previous instances of price struggles near round numbers often preceded either significant capitulation events or strong recoveries, depending on the prevailing macro backdrop. In 2022, for example, aggressive monetary tightening led to deep drawdowns, followed by a multi-year recovery fueled by institutional inflows and technological advancements. The present situation in 2026 shares some similarities, particularly with ongoing adjustments in global liquidity, yet differs in the scale of mainstream integration and regulatory clarity emerging in various jurisdictions. Long-term holders who weathered past storms often cite the importance of viewing volatility not as a deterrent, but as a feature of an emerging asset class with asymmetric upside potential. That said, newer participants are advised to approach with education and caution, recognizing that while the technology underpinning blockchain continues to innovate, price action can remain disconnected from fundamentals in the short term. Several potential catalysts could influence the market's direction in the coming weeks and months. On the positive side, any easing in geopolitical tensions, such as progress in international negotiations affecting energy markets, could boost risk appetite and support a rebound in crypto valuations. Clarity from regulators on key issues like stablecoin frameworks, decentralized finance oversight, and tax treatments would further enhance confidence. Technological milestones, including upgrades to major networks like Ethereum's continued scaling efforts or advancements in Bitcoin's Lightning Network for faster transactions, provide underlying value propositions that strengthen the case for adoption. Institutional interest from corporations adding Bitcoin to balance sheets or pension funds exploring allocations remains a structural tailwind. Conversely, persistent inflation data, unexpected policy shifts from central banks, or equity market corrections could prolong the consolidation phase. Monitoring key economic indicators such as employment reports, CPI releases, and central bank meetings will be crucial for timing potential shifts in sentiment. For investors, the current environment calls for a balanced approach that prioritizes due diligence and long-term thinking. Diversification across asset classes, including traditional equities, bonds, and commodities alongside crypto, can help mitigate risks associated with sector-specific volatility. Within crypto, allocating based on risk tolerance, perhaps with a core holding in Bitcoin and Ethereum supplemented by selective exposure to high-conviction altcoins, remains a common strategy. Tools like dollar-cost averaging allow participants to smooth out entry points over time, reducing the impact of trying to time volatile markets perfectly. Risk management techniques, such as setting stop-loss levels, using hardware wallets for security, and staying informed through reputable sources, are more important than ever. Educational resources focusing on blockchain fundamentals, wallet management, and market cycle analysis empower individuals to make informed decisions rather than reacting emotionally to price swings. While the allure of quick gains is strong during bull phases, the current volatility serves as a reminder that sustainable participation requires patience and resilience. Examining the broader ecosystem reveals ongoing innovation that could shape future valuations. Decentralized finance continues to evolve with more efficient lending protocols, yield optimization strategies, and cross-chain interoperability solutions that aim to reduce fragmentation. Non-fungible tokens and digital collectibles have seen renewed interest in niche applications tied to gaming, music, and real estate, though the sector remains sensitive to overall market liquidity. Web3 infrastructure projects focusing on decentralized identity, data storage, and privacy tools address real-world problems, potentially driving utility-based demand independent of speculative trading. Bitcoin itself, often viewed as digital gold, benefits from its fixed supply cap of 21 million coins, a feature that contrasts sharply with fiat currencies subject to monetary expansion. As halvings reduce new supply issuance over time, this scarcity narrative gains prominence, particularly during periods of global economic uncertainty. Analysts project that as more nations and institutions recognize Bitcoin's role as a store of value, its integration into portfolios could deepen, supporting higher equilibrium prices over multi-year horizons despite interim fluctuations. Volatility in crypto is also influenced by sentiment indicators and social dynamics. Fear and greed metrics have oscillated, with periods of extreme fear often corresponding to local bottoms where contrarian investors begin accumulating. Social media platforms and news cycles amplify both optimism and pessimism, sometimes leading to self-fulfilling prophecies in the short term. Professional traders emphasize the importance of separating signal from noise, focusing on verifiable data such as exchange inflows/outflows, hash rate for Bitcoin's network security, and active address counts as proxies for usage. In the current phase, with Bitcoin struggling below $76,000, some view this as a healthy correction that shakes out weak hands and sets the stage for the next leg up, provided macro conditions cooperate. Others caution that without fresh positive catalysts, sideways action or further tests of lower supports around $70,000 or below could materialize. The truth likely lies in a nuanced middle ground where preparation for multiple scenarios is key. As we consider the global context, regulatory developments around the world play a significant role. Jurisdictions in Asia, Europe, and the Americas are advancing frameworks that seek to balance innovation with consumer protection, which can either foster growth or introduce temporary headwinds depending on the specifics. For instance, clearer guidelines on custody, taxation, and anti-money laundering measures build institutional trust, while overly restrictive policies can drive activity to more friendly locales. The European Union's MiCA regulation and similar initiatives elsewhere illustrate efforts to mainstream crypto, potentially attracting larger capital inflows once compliance infrastructures mature. In the United States, ongoing discussions in Congress regarding crypto bills could provide pivotal clarity, influencing ETF products, staking services, and broader adoption. These developments unfold against a backdrop of increasing mainstream visibility, with cryptocurrencies featured in financial news, corporate earnings calls, and even political discourse, signaling a shift from fringe to foundational in the financial landscape. Delving into Ethereum's position, the network's transition to proof-of-stake and subsequent upgrades have enhanced its energy efficiency and scalability potential. Yet challenges like high transaction fees during peak demand persist. Layer 2 solutions such as Optimism, Arbitrum, and others have alleviated some pressure by offering cheaper and faster alternatives, driving ecosystem growth in decentralized applications. The introduction of restaking mechanisms and modular blockchain architectures further expands possibilities, attracting developers and users seeking yield and functionality. However, Ethereum's price performance has often lagged Bitcoin during certain market phases due to its utility focus versus store of value appeal, though long-term believers argue that increased usage will eventually translate to higher valuations. Monitoring metrics like total value locked in DeFi and daily transaction volumes provides insights into real adoption trends beyond price speculation. Other notable assets contribute to the market's diversity. Solana has built a reputation for high throughput and low costs, powering vibrant NFT and DeFi communities, though it has faced criticism regarding network outages in the past. Ripple's XRP continues to navigate legal landscapes while focusing on cross-border payments, with utility in traditional finance partnerships offering a bridge to mainstream use cases. Meme coins and community-driven tokens add speculative flair but carry higher risks due to their reliance on hype cycles. The rise of artificial intelligence integrations within crypto, such as decentralized compute networks or AI agents on blockchain, represents an emerging frontier that could unlock new value propositions. As the market matures, differentiation based on technology, use cases, and team execution becomes more pronounced, rewarding thorough research over blanket exposure. In assessing the outlook, it is prudent to acknowledge both opportunities and risks. On one hand, the combination of technological progress, institutional infrastructure, and global economic shifts toward digital assets positions crypto for potential long-term growth. Supply dynamics, particularly Bitcoin's halving cycles, historically correlate with bull markets, though timing varies. On the other hand, external shocks, from regulatory surprises to macroeconomic downturns, can prolong periods of consolidation. Investors are encouraged to maintain a portfolio aligned with their financial goals, risk tolerance, and time horizon, avoiding leverage that could amplify losses during volatile episodes. Continuous learning, engagement with community resources, and consultation with financial advisors, where appropriate, form the bedrock of responsible participation. The current struggle of Bitcoin below $76,000 serves as a live case study in market psychology, where fear can dominate temporarily, but fundamentals endure. Furthermore, the environmental narrative around crypto has evolved, with many projects emphasizing sustainable practices through renewable energy usage in mining and proof-of-stake consensus. This shift addresses past criticisms and aligns with broader ESG considerations that influence institutional capital allocation. Bitcoin mining, in particular, has increasingly tapped into stranded or excess energy sources, potentially contributing positively to grid stability in certain regions. Such developments enhance the sector's social license to operate and appeal to conscientious investors. As awareness grows, the interplay between crypto and global sustainability goals may become another supportive factor in its maturation. To wrap up this comprehensive overview, the cryptocurrency market's renewed volatility, highlighted by Bitcoin's position below $76,000, reflects a complex interplay of factors that demand careful navigation. While challenges persist, the underlying innovation and adoption trends provide a foundation for optimism among those with a measured approach. At Crypto Hub, we remain committed to delivering timely, professional analysis to help you stay informed in this dynamic space. Thank you for joining us today. Stay vigilant, invest wisely, and we look forward to updating you on the next developments in the world of crypto. This has been a detailed market update from Crypto Hub.